It's been yet another quarter of a loss for Interglobe Airline, which is the India's largest listed airline. In fact, if we are looking at the overall performance, while the revenues and profitability are significantly under pressure, there has been some amount of improvement in terms of the EBITDAR margin. Loss of nearly around 620 crore has been reported. The loss has, of course, narrowed down on a sequential basis. Revenues have come down nearly around 15% on a YOY basis, understandably on account of the COVID impact. However, if we are looking at the EBITDAR margin, that has improved to 20.1% versus 19.7% in the same quarter last year. This is on account of lower fuel cost and lower maintenance cost. There has been, the other income has come down, but IndiGo has also reported some amount of forex gain during the quarter. In the presentation of the press release, management has guided that Q4 FY21 capacity in available seat kilometer is expected to be about 75 to 80% of Q4 of last year. And also they have reported that the revenues per average seat kilometer are of course down on a YOY basis at 16.4%, but they have slightly improved on a sequential basis. Cost parameters also have improved on a YOY basis. In fact, if I'm looking at the overall cash balance, well, they have strong cash balance of 18,365 crore, of which nearly around 7,400 crore is free cash and 10,900 crore is restricted cash, and total debt, this is debt inclusive of capitalized operating lease liability, that stands at 27,700 odd crores. Management has stated that the high level of the consumer confidence in the product has indeed been hardening, and they are glad in terms of the recovery that they are seeing. CEO has stated that we look forward to a gradual opening up of international scheduled flights during the next few months, because increased capacity and aircraft utilization are very critical for our return to profitability. They have also stated that we had promised to come out of the crisis stronger, and we went in with a full commitment with all our employees, and they are fairly happy with the kind of performance so far. In terms of the conference call, management has stated that they would not be raising any money from QIP, and their internal sources of funds would be sufficient to meet their overall operations. Management also stated that overall, if they are looking at financing, then debt options are enough for them. If at all they need, they would be raising money via various debt options. Management sounded fairly optimistic in terms of demand. While the demand was fairly strong in the month of November as well as the first week of December, from mid-December onwards until first week of January onwards, demand did cool off slightly on account of the impact of the new variant, and hence management stated that they're optimistic of demand in the absence of any new variants of COVID or resurgence of COVID. They stated that they are in conversation with the government for enhanced capacity for the airlines, and also they stated that it would be difficult for them to get back to green unless and until they do see further improvement in terms of overall capacity utilization. They stated that they are working hard in terms of to increase capacity, optimize cost, as well as improve revenues, and also that employee costs would be lower by 30% on a YOY basis. They also stated that the good news is that the revenues are slowly coursing up along with better capacity, and they look forward to a better capacity utilization, and the overall bookings are now picking up since mid of January. So yes, they sound fairly optimistic in terms of demand, but higher government allowing higher capacity utilization seems to be critical for better profitability of the airline.